Thank you so much for joining us. This is our third installment of our health and wealth series that we started, doing everything that we can really to just continue to bring added value to you. And we certainly miss being face to face with all of you. But this is the next best thing that we have right now. And we're very excited about the guests that we have. For those of you who were not on yet when we started chatting just a few minutes early there, hi, Dave and Julie. You will see a chat feature. It looks like little thought bubbles, if you will. And if your default is the same as mine, that will appear at the bottom of your screen. It could be, however, on the side or at the top. And if you click on that chat feature, you will also see where you can either submit a question to everyone. So all of our attendees would be able to see that question. Or if you prefer it to be more confidential in nature, then you can just select panelists. And if you do that, the only people who will see your name and your question will be the panelists that you see here today, myself. For those of you who I don't know yet, my name is April Cruz. I'm co-CEO at Reed Financial Group. I'm going to turn things over very shortly here to my co-CEO, my sister, Abby. She's going to have the honors of introducing our guest speaker today that we're very excited about, but please feel free to ask questions. Hi there, Nelson. Feel free to ask questions as we go along. We will be fielding questions at the end, but if you want to go ahead and start filling those out as we go along so you don't forget your question and so we can go ahead and compile those, then please feel free to do so. And without further ado, Abby, I'll let you take it away.
Thank you very, very much, April. As April said, a lot of y'all that are on with us today, I have had the pleasure of either working with or meeting, if you are one of April's lucky people. So for those that I don't know, my name is Abby Reed. I'm co-CEO of Reed Financial Group. We are a family-owned and operated business. Our father started Reed Financial Group long time ago, over 40 years ago, and we are carrying the torch, so to speak. We are investment advisor representatives, which means we are fiduciaries by law. We also have life and accident and sickness licenses. I have a finance degree from Kennesaw State University. So that's a little bit about us. So I won't get too far into that because most of you know us very well by now, but that's who I am. Thank you very much for joining us today. I want to go ahead and start to introduce our guest speaker, our expert spotlight. This is our third episode of our health and wealth series that we started several months ago when all of the pandemic stuff started happening. So we've really enjoyed being here with y'all. We're glad that you've joined us, and we're going to cover a really, really great topic today. Kit does a fantastic job of covering and starting discussion about a topic that's not fun or sometimes not easy to talk about, but it needs to be talked about, and that's long-term care, planning for long-term care. Kit has worked for nearly a decade in the life insurance planning concept arena. So that includes estate management, tax diversification, and long-term care planning. So he's really dedicated the last 5 years to the long-term care planning space. And he travels all around the country to the advisors that he assists, including us, and talks to their clients about different strategies, different techniques, and brings just some wonderful information to the table. He has the heart of a teacher, as I like to say. So he's very educational, he's very knowledgeable, and he lives here in Georgia. So we like that even more. He graduated from UGA, and he's an avid Bulldog fan. So we like that too. Well, April and Daniel might not. They're Tech fans because Daniel went to Tech, but we won't hold that against them.
I was going to say, hold on a minute.
Kennesaw didn't have a football team when I was there, so I just like UGA. I had to pick someone else. And he lives in Holly Springs with his wife, Amy, and their cute daughter. So I'm going to go ahead and turn it over to Kit. We will be taking questions throughout the presentation in the chat box. So it will save the question and answer till the end. We will be taking those questions, compiling them, so you can go ahead and chat those in that box. Without further ado, I think I've covered everything that I plan to cover. So I'm going to turn it over to you, Kit. Take it away.
All right. All right. Well, first of all, I think the easiest thing to say is it's so nice to present to a group of people who understand what I'm saying. You know, it's so great to talk in the South because look, I've been to New Jersey and Pennsylvania and Arizona, and there are a lot of places all over this country where they have no idea what to do about it.
Right.
Um, so it's nice to be at a place where I think people can understand what I'm saying. But I appreciate that that introduction, and I appreciate y'all being on the call. I see we've got a really, really good group here today, and I got to tell you that I think that's really awesome. It's a very, very good thing that you're taking the time to get as much information about this as possible. And I want to emphasize the information part really, really strenuously here. I know whenever you go to a presentation, or if you've ever gone to a seminar in the past or something like that, there's usually kind of this buy-in at the end of the presentation, right? Oh, you need to do this and it'll all be fixed. We're not doing that. I'm not doing that here. What I love about April and Abby, Daniel and Gary and all the folks over at Reed Financial, they are truly dedicated on client service and letting clients talk about what their goals are and trying to get through retirement rather than trying to get to retirement. What I mean by that is they're the type of firm that plays financial offense and financial defense, okay? Financial offense is about growing your money to get you to retirement. Financial defense is about protecting your money so that you can get through retirement. And they really, really focus heavily on that. And financial defense looks a little bit different for everybody. So what you're going to get today is I give you my word on this, and I really want to be as kind of direct as I can about this. You're not going to get a pitch. There is no product that is going to solve all this problem. There is no simple one type of solution that's going to work. We're all wearing different clothes. We all live in different houses. We all drive different cars. Our solutions are going to look different between each person. But there are solutions out there. We're going to talk about those, and you're going to find whatever is going to work best for you, and then the folks over here are going to help you out, okay? So let's talk a little bit about what we're going to cover today. Yeah, it is going to be a who, what, where, when, why of long-term care. Now, one thing you need to know, I'm going to refer to it every now and then as LTC. LTC is short for long-term care, okay? So anytime you hear or see LTC, know that that's what it means. We're going to talk about what's considered long-term care, why it needs to be part of your retirement strategy. Now, I cannot emphasize this enough. A long-term care event and trying to avoid a long-term care event is a conversation with your doctor. Planning for long-term care is a conversation for your financial advisor. Long-term care planning is about your money. It's about your retirement. It needs to be factored into your retirement strategy because a long-term care event can easily derail your retirement plans if you're not fully prepared for it. So, and I'm not saying that to scare anybody. Trust me, we're going to be overtly positive today because the good news is, and there is good news, is that there are solutions for this. So we'll talk about when it's needed. We're talking about questions that you need to ask yourself in crafting a plan, options available to you, and then some next steps. Okay. So let's talk a little bit about what's considered long-term care. Now, there's only two types. There's informal methods and there's formal methods. Very simply put, most people choose the informal method at first if they're able, meaning they have somebody from their family or their friends or somebody within a community organization like a church or what have you come and give them help. You know, maybe they need just a little bit of help. They don't need full 24-hour around-the-clock help. And so in those informal methods, most people tend to try and stay in the home or they move in with a loved one and they just kind of receive this unskilled care. Maybe great care, but it's care that doesn't come from somebody who went to school for it or got a certification for it or something like that. If that long-term care need progresses, they typically go to a formal method, which is usually in a brick and mortar facility like an assisted living, a nursing home, an adult daycare, but something that is also on the table in a formal method and something that I think will be a lot more popular after the coronavirus COVID-19 thing kind of tampers down is going to be qualified in-home care. I'll give you a statistic real quick that you need to know. I've got an article. I could send it to Abby in April, but it just came out in Forbes, where so far 43% of the deaths that have come from COVID-19 have occurred in some type of long-term care facility, an assisted living or a nursing home. What that tells me is that people are going to see a statistic like that because the news is starting to talk about it more. People are going to see a statistic like that, and they're going to want to find ways to stay in home to where they only have to worry about one person or two people that may be infected with the flu or some other type of virus, as opposed to 30 other, 50 other, 90 other people. Okay, but keep in mind two types: informal and formal methods. The way that you qualify for having a long-term care need is actually a medical conversation you have with your doctor. It's through being able to perform activities of daily living. Now, what those are, there's 6 things, and it's these 6 right here. Don't think about the definitions of what these things mean, okay? What I want you to think about is that every single one of these 6 things are things that we do, hopefully, before we step out of our house every single day, right? When we were all going back and forth to the office like it was normal, I would get up, I'd get out of bed, there's my transferring, I'd go into the bathroom, take a shower, do some other things we don't need to talk about. I'd get dressed, I'd go downstairs, grab me a bite to eat, and I'm out the door. 30, 45 minutes to get my day started. If I couldn't perform one of these things, think about how long it would take me just to get ready to get out the door. If I couldn't perform 2, I have to have assistance to be able to get my day started, right? And so that's what a doctor looks at. And again, a doctor, not an insurance company, not a nursing home or anything like that. This is what a doctor looks at to certify whether or not you have officially a long-term care need, okay? But why is all this important? Because, look, again, I'm going to be overtly positive about this because I think there's a lot of good news here in crafting a plan and getting ahead of the game, but there is an urgent need. And so this will be the most sobering slide that y'all see, but I do want to point out what it means because it's just data at the end of the day. It's not good news or bad news. It's just data. And so here's what we have. So if you look at this little right here is nearly 70% chance. If you live to age 65, you now have a 69.8% chance, so it's close to 70 just about as you can get, of having a long-term care need in retirement. Now, what does that mean? It's not 69.8% if you rock climb or hang glide or scuba dive or do anything like that. Not 69.8 if you're male or female or whatever. Just by living long enough, you have a chance, a significant chance of having a long-term care need in retirement. Think about it on the inverse side to where if you were catching a flight and you were going to go over to California, if you only had a 30% chance of that flight making it to California, you and I both know you wouldn't get on, right? You're not punching that ticket. So when the chances are that you're much, much more likely to, not have a need as opposed to, or much more likely if you having a need as opposed to not having a need, it's worth considering, it's worth planning for. When you have that event, you could be on claim for 4.3 years. That's if you have and can't perform the 2 of 6 activities of daily living, more of a physical claim, right? When you look at nationwide, the cost of a facility nationwide, a nursing home, is about $9,000 a year. Over 12 months, that's $108,000. Over 4.3 years, you're getting close to $450,000. So that's a massive expense that can really come out of nowhere on average, okay? If you have a cognitive impairment, which is another way that you can have a long-term care need, like dementia or Alzheimer's, you could be on claim for 4 to 8 years. The memory care types of facilities, they also have, significant costs with them. It's about the same. So when you're looking at potentially having a need and how long that need could take, you could be on claim for quite a while, and it could cost you a lot of money if you're not prepared for it, okay? So let's get out of that. All right, perfect. I don't know why my little spotlight thing hung up on me. There we go, got rid of it. Here we go. So when's it needed? We know about 2 of 6 activities of daily living. I'm gonna try to speed up. I don't want this to go too long, but just keep in mind, there's very common things that can lead to a problem. You can fall. You could have a car accident. It's not even your fault. You could have a chronic illness, bad knees, bad back, shoulders starting to hurt you, things that you can see coming down the road, strokes, if there's a history there, or if there's, if you have high blood pressure, things like that, things you need to consider. Cognitive impairments, if that runs in your family history, all these things are worth considering. Again, you have to look at your own situation and see what your family has done, because there are a lot of genetic ties there. Questions you need to ask yourself. Let's breeze right through this because I'm going to go over each one of them. First thing, how can it affect your family and or your retirement strategy? First thing you got to decide, am I using informal care or formal care? Okay. If it's informal, who's providing that care? Does that person also know that, right? There's a whole bunch of people out there that say, oh, my spouse will take care of me. Keep in mind, your spouse is going to age like you do. So if they're roughly the same age and you're having a hard time getting around at age 80, they're also going to have a hard time getting around at age 80. So usually 80% of the time, it ends up being one of those situations where you have somebody who is a daughter or a daughter-in-law taking care of you. So does that person know that they're the ones that's kind of earmarked to provide that care? Bring them in the process. Make sure they understand what your wishes are. If it is formal care, if you say, look, I don't want to be a burden on my family, I don't like that terminology, but a lot of people use it. But if they say, I don't want to do that, then, fine, not a problem. Do you know where you would like to go, what facility that is? Who's overseeing that process, right? You still need to have people designated to help you out because you may not be in a position where you can make those decisions on the fly. So it's important to know this stuff in advance if possible. Are you going to use insurance or a portfolio asset? Now, insurance is a totally different conversation. We're going to go in depth on that in a second. But if we're going to use an asset, the folks over at Reed will tell you the most important thing that you can do in retirement is to make sure that your retirement income is all set. That's number one. I'm here talking to you about long-term care, and I'm telling you, number one thing to do is make sure you have money in retirement. That's the most important thing. You got to keep a roof over your head. You got to keep food on the table. You got to keep up with your health care, all that stuff. So anything that could be used for income, even potentially, right? Could I use this for income? When we're planning, let's take that off the table because that's more active money. What we want to look at first is that passive money that maybe could be leveraged or more efficient somewhere else, okay? So if it's used for income or could potentially be used for income, at least initially, let's take it off the table, okay? And then the second thing is it subject to taxation? The most important thing that you can remember is that Uncle Sam is your silent business partner in retirement, and he will always get his. He is going to increase or decrease his share without your vote or your consent, really, depending on what our needs are in this country. And I will tell you, we just added $1 trillion to the deficit. We're about to add $2 trillion more. And it's becoming one of those things that's getting close to being unmanageable. Taxes will go up in the future. So if you're saying, well, I've got this old IRA I'm not going to use for income, I'll use that. There's $100,000 in there. Keep in mind, it's not really $100,000, right? So things to consider there. Now, let's keep on going. What could it potentially cost? All right. So what you want to do is you want to know who's giving that care. Where could it be given? Remember, Florida's going to be different. Arizona's going to be different than New York. It's going to be different than Alaska. So long-term in retirement, where are you going to be? How long is that care going to be needed? We look right now at 4 to 6 years. The data tells us 4 right now. 15, 20 years from now, could it be 6? Sure could. We don't know. So let's plan for that. And at what age will care be needed? Statistically speaking, we're looking at late 70s, maybe early 80s. So we target age 80 as what benefit do we have at age 80? What can we use at age 80? But as time goes on, does that turn into age 85? Does it turn into age 83? I don't know, possibly. We'll see where the data takes us, okay? But it's important to know the cost of your care in the area for things like homemaker services or adult daycares or assisted livings and nursing homes. And the great thing is that there's tools. We have tools we've provided to Reed Financial to make sure that they know what the cost of care looks like today, what it looks like 10 years from now, 15 years from now, 20 years from now, and so on. So if you say, I'm 60 years old, what does it look like 20 years from now if I decide to move to Tampa, Florida to be closer to my family? We can identify that, okay? So keep on going. Sorry, my computer is dragging just a little bit, so it's just delaying, as it tends to do, because of course it worked earlier, right? So anyway, so what options do you have available to you? Now, let's go ahead and tackle the kind of elephant in the room. Medicare and Medicaid. Medicare is the same across the board, regardless of state. It's a federal program. That means that it's the same here as it is in New York or California or whatever. There is no LTC benefit with Medicare. There is a skilled nursing benefit for 100 days after you stay in the hospital, okay? But being from Athens, Georgia, I'm going to use an Athens, Georgia analogy, so or going to school in Athens. Here's the deal. You go to a hospital, you qualify, you go into a skilled nursing facility, days 1 through 20, you don't pay anything. There's no copay. Day 21 through 100, you're paying a copay to be in that facility. But in day 101, it is like a bar at 2:15 in Athens, Georgia. You ain't got to go home, but you can't stay here, right? They are closing you down. They are kicking you out, okay? Unless you have to stay there or you've got somewhere else to go or you go back to the hospital to requalify. But that's all you get. You get 100 days of a skilled nursing benefit in order to receive care. But you have to plan basically from day one, okay, if this lasts longer than I anticipate, where am I going to go? Medicaid is entirely different. Medicaid will cover the cost of care, but there's some hoops you have to jump through. I don't know if y'all know this. Government comes with a lot of red tape. Just tends to be the way that it is, right? So if you want to, on paper, essentially have no wealth, right? No assets, nothing like that. Then what you have to do, and you need to work with the folks over at Reed to do this, get everything out of your estate today or as quickly as possible. And the moment everything is out, wait 5 years. And then after 5 years, Medicaid will cover your cost of long-term care services, okay? Now, Medicaid does vary by state because it is more of a state-based program, okay? So Medi-Cal is what they have in California. Medicaid is what they have in Georgia. So if there's a chance you may go to a different state, you might want to check on that further. But as it stands right now, just a general rule of thumb, you got to be broke on paper for 5 years, and then Medicaid will cover the cost. The only thing is, also keep in mind that Medicaid forces you to go to a facility that is covered by Medicaid. You don't get your choice. You get a Medicaid-approved facility, okay? So again, you got questions on that, ask the folks over at Reed. They'll be able to help you out, okay? So self-funding. Well, let's talk a little bit about self-funding, and the way of going about it is just talk about Bob. Okay, so here's Bob. Everybody likes Bob. He's a very svelte guy. He works out. He has a Peloton, whatever that might be, right? So Bob has an event, and he requires LTC, okay? Bob has all these different buckets, just like everybody does in their portfolio. Here's the things that Bob has to consider. Let's say he has a savings and money market bucket, and he saved up $100,000 in there. We all know that when you have money in the bank, who wins on that? You or the bank. And I'm asking that rhetorically because I could just hear people on their side of the computer saying, the bank does. Of course the bank does, right? So when you keep money in the bank, it's great that it's liquid, it's great that it's protected, but it's also really money that the bank's winning on because they're loaning against it and they're charging a better interest rate than what they're giving you, okay? So while Bob had $100,000, if that had been the case 10 years ago, it might have covered the cost of care for him for 2.5 years. However, this barely gets him through a year of benefit in a facility, depending on what type of facility, right? So the longer you keep lazy money, and I know the folks at Reed talk endlessly about lazy money. It's one of the smartest things that they do, is that when your money's not working for you, it is essentially working against you. And so while Bob is great to have this liquidity, it's not necessarily as efficient as we would want it to be for when that rainy day comes. So then Bob takes a look at his annuities and IRAs. Now, let's say Bob's married to Sue, and Bob and Sue live on a fixed income stream of $80,000 a year. So think 80 grand in your head. Bob goes into a facility that costs $60,000 a year. So 80 minus 60 is $20,000 that's left over. Now Sue is at risk because she has to live on $20,000. Remember, their income stream is fixed. So the only way that Sue gets by on $20,000 is to either severely cut back on her lifestyle, or she has to start surrendering from her nest egg, or start surrendering from her annuity, or if everything is locked up in a pension and a Social Security, she's really in trouble, right? And because you're not getting advanced on either of those. So keep in mind, when you're on that fixed income stream, this is why we take income off the table for the planning purposes, is in situations like that, you can have one person get taken care of who essentially has the event, but it's the person that they depend on that income for that's now at risk, okay? Stock, bonds, and mutual funds, we all have seen what the market has done lately. That's not a bad thing. We all know it's going to come back, okay? The problem is that we want to leave that money there untouched so that it can rebound, you know, and it has been. It's been doing great. But if the market fell out and then somebody came and took money out of it, you've essentially, you know, you've confirmed those losses. What we want to do is we want to leave that money there and time that market to try and be back on the upside. Now, that's all well and good if we time it right. But again, there's risk with market volatility to take in mind there, and sequence of returns risk, which we all know the folks at Reed have talked about as well. And then when it comes to real estate, you know, the great thing about real estate is that you do have options there. There's flexibility like a reverse mortgage. You know, you can downsize and cash in the equity in your home and all these different things. These are all viable options. But again, I don't know if anybody's trying to sell an illiquid asset very quickly, but you and I both know when that happens, you don't get the best deal. If you need to get your hands on that money now, you're willing to take whatever deal comes. So you might lose 10, 15, 25%, 30% of your value that you would normally get if you were patient, just because I got to go now, right? So just keep that in mind. These things are all viable options. I don't want to say that they're not. But when you self-fund, one of the things that you bring into play is outside risks that are outside of your control, okay? So let's jump back just a little bit. Let me get rid of my little pointer here. Okay. I said pointer, and for some reason the Pointer Sisters popped in my head, so now I've jumped for my love stuck in my head. I'm sorry about that. This is what it's like to be in here. So anyway, what are your options? Let's talk a little bit about informal care. Things to consider. Is whoever that person is that's providing that care, you want to look at their availability. Do they work full time, right? If you've been a caregiver, and we've got enough people on this call to make me think that there are people here that have been caregivers for others before. And so if you've ever been a caregiver, you know that usually comes at a time when you're making the most money of your life, right? So if you've got somebody that's giving you care in an informal setting, are they also working full time trying to prepare for their retirement? On top of that, are they close to you? I mean, we all live in Atlanta, right? You know that in Atlanta, you can't go 5 miles down the road and it take less than 20 minutes. I'm from Perry, Georgia originally. I can get all the way across town in Perry, Georgia in 10 minutes flat, and it's 10 miles, right? But in Atlanta, if somebody lived 10 miles from me, I'm a 45-minute drive, depending on the time of the day, to get there, right? So you have to look at availability, proximity. And also, if you've been a caregiver, you understand there's a physical, financial, emotional impact to caregivers that I don't want to harp on, but we all know it's significant. So it's something to consider. And then going into that, let's talk a little bit about insurance. Okay, we'll skip this slide because we're going to go back to Bob. So for the longest time, there was something called traditional long-term care, right? And it was basically you pay a premium. That premium goes into a shared risk bucket of how insurance work, right? These companies have this shared risk bucket. And then when you go on claim, they pay out, out of that bucket to cover the cost of your care. For 40, 45 years, this dominated everything, right? This was the 70s all the way up until, or maybe in the 60s, really, with some carriers, all the way up until like the early to mid 2000s. All right. So you would have, Genworth and John Hancock and all these other companies in this space. What ended up happening is a majority of these types of policies were written in the 80s when interest rates were at 8, 9%, 7%, and so on. So we all know that didn't last like they thought it would, right? So their books basically showed them making money that didn't exist. So in order to continue these policies, what they ended up having to do was they had to either start raising premiums or cutting benefits or doing a combination of both. And then with some carriers, they even offer these buyouts where they say, okay, you quit paying, here's all your paid up benefits, very, very low for what you were promised previously, or you can get a portion of your premium back and we just call it a day, right? And that's because People started living longer. Cost of care went out of control like it is right now. And then their returns weren't as great. Plus, if Bob just spent, $200 a month for all that time and ended up passing away, he got nothing for it, or his family got nothing for it, right? So the potential for you to pay in a whole bunch and not get any value was great. So what they decided to do, people like Bob have said, yeah, you know what? I don't want to have to make this decision. I don't necessarily know if this is the best fit for me, when they were evaluating all the options available to you. And so long-term care, or traditional long-term care, started to have this kind of drawback in market share right around 2005, 2006. And then when the financial crisis happened, they took a big, big step back, because people said, look, if I want to spend my money, I want to make sure it's something that I get the value for. And Abby, I know you and I talked about that. You have a personal experience with that too.
Right. Yeah. So April and I, our grandmother, actually both of our grandparents, two of our grandparents needed assistance. We have longevity in our genes, thankfully. One of our grandfathers and one of our grandmothers both lived into their late 80s and then early 90s. So both of them needed some sort of care. So we have seen that personally. Our grandmother had traditional long-term care, like you're talking about here, and she was a widow. So she, like you were saying, she didn't want to be a burden on anybody in the family. That was really important to her. So she did what she was supposed to do at the time, and went out when she was in her 50s, and got a traditional long-term care policy. And she ended up needing care. She did not want to go to a facility. That was like the worst thing for her, which I completely understand. She wanted to stay at home. So we had the experience of trying to utilize that long-term care. And there were some hoops to jump through with that, but they did pay for some certain things, but it just wasn't that much. She had been paying since she was 50. The premiums kept on going up, and she was on a fixed income. I mean, she was on like a very fixed income. She was a widow since she was, in her 40s, I think, or 50s, and she was in her 90s. She was on a fixed income for a long time. So that really affected her. It affected her income that she could spend, and there's just no way that she got what she put into that. And it was what she was supposed to do at the time. It was a smart thing to do, but because of the changes in the long-term care space, she didn't get her money's worth. And that really, I've always been passionate about this, but that really made me even more passionate about it, is using strategies that are just more efficient and better for the whole family, so that our loved ones can get the care that they need. We can still spend that time with them, but it's more quality time instead of being their caregiver. April and I experienced that as well. Just giving the family and the loved one options, the freedom to make choices that are in their best interest. So April, I don't know if you want to add anything to that. You were, right along there.
Yeah, I would just say that I also believe, again, just going to firsthand experience, that probably one of the most eye-opening aspects of a situation like that is it's not always about the willingness of loved ones, but the ability. We talked about whether they're working and what their proximity is, but in this instance with Nana, it came to a point where there had to be someone there who could physically pick her up and move her safely without injuring themselves. And there's an element of that, and also, frankly, when someone declines and does not have the capability for some of those ADLs that we were talking about earlier, often it can take an emotional toll, not only on the caregiver, from having to assist with those things, but both with her and with our grandpa. It did a lot as far as toll on them for having to ask for certain things like that. And I believe that that both of them quite almost found it a little bit demoralizing to have to ask that of their children and grandchildren. So certainly another aspect to think about. I know that's not all sunshine and rainbows by any stretch there, but a very real aspect of relying on loved ones exclusively for help, and what long-term care might not cover.
Yeah, and I mean that's the thing about it. I mean, the thing is that everybody has a personal experience. I have one with my grandmother, right? I mean, my mom. I watched my mom take care of my grandmother, who lived to 98 and was in and out of care for or I don't want to say in and out of care. She went to care when she was 90. She lived 98, and went from the living, essentially next door to my aunt to living in an assisted living facility in my hometown where my mom helped out, and then moving to a nursing home, right? And so kind of graduating each step. And it does, it takes an impact. I mean, look, y'all, I try to have fun. I try to make jokes. I try to, be a fun loving guy, but this is a serious conversation. And it is one that it's tough to sometimes present this, because those people that have had this type of experience, how heavy that can be. And so that's why, again, I can't commend everybody enough on this call and the folks over at Reed for wanting to do this, because it is important. It's a very, very important part that a lot of advisors shy away from, because it is such a conversation to have, right? Such a tough conversation to have. But that's the good news, is that we're talking about it. We're going to take all the sting out of it right now, right? So going back to the traditional long-term care, you see what kind of made it lose some market share over time. So what ended up happening was it created an opportunity for life insurance companies actually to give some type of long-term care LTC benefit out of the policies that they were writing. And this started happening in about 2008. So when the financial crisis came, it created an opportunity for life insurance to say, okay, what can we do that's very attractive and very right now, right? And it ended up being looking at the market share that traditional long-term care insurance was losing, and then saying, well, is it a way that we can make people or allow people to accelerate their death benefit while they're alive to cover these expenses? And the first instance was a situation like this, where you basically have a life insurance policy with this big bucket of money that you can use two different ways. If you pass away, then we all know what happens with life insurance. You pass away, and then your family, your heirs, your benefits, whomever this is, gets this bucket of money income tax free. If it's a $300,000 death benefit, that's what you get, $300,000 income tax free. However, if you instead need living benefits, like long-term care, you qualify with the 2 of 6 activities of daily living, all that stuff, then what you can do is you can actually accelerate that, and you can get on a monthly basis money out of your death benefit in order to cover the cost of care. The way you qualify for it's the same way that you qualify under traditional long-term care. 2 of 6 activities of daily living, or the cognitive impairment, certified by a doctor, not certified by the insurance company, not up for debate with the insurance company. Doctor fills out a form, you're done, okay? This became wildly popular for 2 main reasons. Number one, remember what happened with Bob. If he just passed away, all that money went to waste, right? However, in this situation, this goes as a death benefit to his beneficiaries. On the other side, the life insurance company knows that in either the LTC side or the passing away side, they know what they're giving up. So they're able to accurately plan for that cost, and they gave Bob premiums that will not increase. They're premiums that are there, they're guaranteed, and they're things that you can count on. I mean, Abby touched on this talking about fixed income. One of the really hard things when you are living on a fixed income is when the world gets more expensive, but your money does not go along with it, right? And so having something that Bob could count on and say, okay, this is what I know that I got, this is what I know I can count on, became wildly attractive. So this started taking over a ton of market share. And then life insurance companies said, well, this is capitalism. Anything we can make good, we make gooder, right? So they created these types of policies called linked benefit policies. And basically what they offered was a 3-pronged approach, I call it live, die, or quit as just a simple term for it. But if Bob lives long enough, he will use this LTC bucket, and it will be a very big bucket, a lot of LTC coverage for what he pays for the product. There's a much, much smaller death benefit bucket. Usually it's either slightly more than what he paid in or just what he paid in general. It's not a death benefit product as far as where the focus is, but there's still value for the money there, right? However, if Bob's needs change and he needs his money back for whatever reason, he can get his money back, no questions asked. So instead of spending that money and it just going away, in the case of Bob needs LTC or Bob passes away, if he just says, look, I just need my money back, I made a bad investment or whatever that is, right? He's just basically moved that money from the left pocket out of the bank in this instance from being, $100,000 and put it in the right pocket, where now all of a sudden it's a much larger LTC benefit, regular old death benefit, and the option to get the premium back. Now, here's the thing. I know that this is not something that a lot of people really know a bunch about. So let me show you what I'm talking about here. So I'm going to share my screen over to this right here. And this is what this looks like. So I'm not showing you the product because I don't want you to be focused on the product, but it does help people kind of understand what this product is when they see the numbers. All right. So here's Bob, right? Hypothetical Bob right up here. Let me get my little pointer. Okay. Hypothetical Bob. He's 63 years old. He's married. He gets a discount for being married. Here's his 100,000 going in. Okay. His day one long-term care benefit guaranteed is $324,331. That's just shy of $4,000 a month in cash for 6 years. Okay. Now, because Bob is a young fella, he's 63 years old, right? Let's look at this same product at age 80. Now, my little screen thing keeps holding up, so I just do this to make it easier. There we go. At age 80, remember Bob put 100,000 in. Here's his return of premium, 100,000, in case he needs his money back, right there. Here's his death benefit, 100,000, in case he passes away. But because we had time on our side, that 100,000 has guaranteed become almost 750,000, $750,000 in the long-term care benefit, coming to him at $9,100 a month. Those are guaranteed numbers. So this type of product is really, really, really seeing a lot of market share growth because of the flexibility there. And even in a scenario where, let's say, Bob doesn't have the 100,000 all at once, he's putting in $10,000 a year for 10 years in this scenario. Still at age 80, there's this $100,000 in case he needs it back. There's this $100,000 in death benefit. There's his total long-term care bucket of $531,000. You get the best deal by putting in the money all at once. That's the way these things are structured. But still, more than $500,000 for $100,000 guaranteed and it all be income tax free is actually a pretty good deal. That's $6,500 a month in cash that Bob could use to build ramps in his home, that Bob could use to pay somebody in his family to be a caregiver for him so that if they have to step back from their job to help, they still have money coming in. There's a number of ways that they can go about it. And so this is why a solution like this has become more popular. Now, if someone says, well, kid, that's all well and good. I don't necessarily know if I'm, the Bob that wants to have so much long-term care. I would like for my family to have more benefit. Then the two bucket approach is a lot more for you, right? This is more of a death benefit kind of either or type scenario. This one with the 3 buckets is much more of I only care about long-term care benefit and making sure I don't lose my money, right? So where do you fall on that spectrum? I don't know. That's a conversation for you and the people that you care about, which is why when we're talking about next steps, this is what you want to do. You want to think about a written strategy. You want to involve the people that are going to be part of that strategy, right? If it's just your spouse, then bring your spouse. If you have an alpha child, which a lot of people do, they have like 1 or 2 children that are really, really involved in helping, and this person takes care of mom, this person takes care of dad, or whatever that might be. You want to involve them too, because they're going to be in on that process, right? And then once you know what you want, we want you to call the folks over at Reed. We want you to sit down. We want you to talk with them about what you want. Don't worry about products. Don't worry about solutions. Don't worry about concepts. That's not what y'all need to worry about. Tell us what you want, because my job behind the scenes is once you all sit there and you talk to Abby, you talk to April, They call me up and they say, okay, I met with, Mr. and Mrs. Smith. They want A, B, and C. My job is to then go and find all the different solutions, all the different, products and what have you that we offer to then match up specifically with what your goals are. Not to try and get you to buy something or spend your money on something or design a platform that doesn't fit what you want. So that's the most important thing. And so then they'll work with you on how we fund it. What do we use within your nest egg or your wealth profile, your portfolio in order to do that. But look, I know how this conversation goes. It's like drinking from a fire hose, right? I mean, that stuff is not lost on me. So what you're going to get, and you're going to get one from Abby, you're going to get one from April, depending on who y'all work with over there. But we have this handout that covers everything that I talked about today that's of consequence, okay? It doesn't make any apologies for my blank wall back here, but it does cover anything of substance, right? So everything from, your retirement strategy to questions you need to ask yourself to even having the Bob conversation. I genuinely want y'all to be able to go and sit down with these folks and say, look, I like Bob with the 3 buckets. Can I do Bob 3 buckets? I want that process to be so simple for you, specifically because everything else in the world makes it complicated. We can make this simple. So look out for the handout. And if you have any questions, by all means, go ahead and ask. And I'm happy to answer anything that y'all have.
Kit, thank you so much. It certainly can be like drinking from a fire hose with a topic like this, but your engagement is wonderful. We've got every single person we started with, so clearly providing a lot of value for our folks today, and we certainly appreciate it. We have been fielding some questions, and I've been individually replying to those. I want to be certain that we answer just as many as we can. One of the first questions that we did receive, and I know this answer will certainly vary depending on the type of coverage, but I'll just read the question to you verbatim here, and then, Kit, you can just, of course, answer as you may, but the question was, will long-term insurance cover assisted living expenses? And maybe you could speak a little bit to the difference there between a traditional long-term care policy, which I think was the context of this question, versus some of the newer alternatives.
Mm-hmm. Yeah, so that's a great question. So yes, the main thing as far as to start the claim with most carriers, okay, if you're in assisted living, that's a formal care scenario, right? So whether, and every product does a little bit differently, but some products do reimbursement of expenses and some products give you cash in advance and you pay however you want to. The ones that do cash in advance are ones that it doesn't matter if you're doing informal care or formal care, okay? You can do either. The ones that just do reimbursement typically only work with the brick and mortar facilities, right? But in both scenarios, you can use traditional long-term care, you can use the hybrid products with the 2 buckets or the linked benefit products with the 3 buckets to cover the cost of assisted living. The main thing about it is if you're in assisted living, if you qualify via the 2 of 6 activities of daily living, which typically you have to do in order to be in assisted living, and that's certifiable by your doctor, again, I can't emphasize that enough, then yes, it will cover the cost of that. It doesn't really have as much to do with the facility as much as it is the doctor being willing to sign off that you need long-term care assistance.
Thank you very much, Kit. The next question that we have is with regards to a bit of a tax angle here. So if you're more comfortable deferring this, we can certainly gather what information need be from the CPA that we have on retainer here at Reed Financial. But the question is, are long-term care expenses deductible as medical expenses that can offset income from taxable assets used to pay for the care? So anything that you're comfortable with speaking to on that, and certainly if any follow-up is necessary, we'd be happy to do that as well.
Yeah. So, and your CPA on staff can actually speak to this as well. But in a very general sense, without getting too into the weeds, there's 2 ways of going about it. If you're a business owner, you can do what's called a Section 162 plan, which is basically a payroll bonus plan that you can use to fund a policy. And you can do that, and the business can get a payroll deduction by doing that. It's one tax advantaged way of going about it. The other thing is that I do have one product that actually also classifies itself as a health product. In fact, it was the one that I showed y'all, to where you can, in certain scenarios, you got to have the type of business line up properly and other things. But I've got a resource at that company that we can set up with y'all and with the client to help walk through and make sure that's all done properly. But there is a possibility of having those expenses deducted. So it's possible. Some hoops to jump through, as everybody would expect, but there's definitely ways of going about it, especially for business owners.
Fantastic. Thank you. Another question that just came in here. Do any insurance companies offer their traditional long-term care policy holders a conversion to linked benefit products?
Not really. And I will tell you why. The traditional long-term care companies that were in this space, Genworth, John Hancock, primarily dominated the space for a long time. They're both out of that space now. Anybody that had products, and you can still have a John Hancock product in a group scenario, but individual sales on that are no longer doable. And same thing with Genworth. Because the traditional long-term care side has taken such a hit, so to speak, a lot of the companies have gotten out of that space altogether, and the ones that remain only do that. I don't know of a product that offers any type of traditional to linked benefit product. You typically need to start in one of those solutions and finish in one of those solutions if that's part of your plan.
Thank you for covering that for us. And another, just a conversation point, perhaps more so than a question, to make people aware of when it comes to the traditional long-term care. It seems to me like from these questions, probably a good number of you who are on this call with us today may have existing traditional long-term care policies. And one of the things that I want to be sure that we cover today with regards to those types of policies and the coverage that they offer is with regards to elimination periods. And a lot of times what we find is that people are not 100% familiar with how this works. I have a client whose mother was in a long-term care facility in her 90s. And the way that her elimination period worked on her particular policy was that the days had to be continuous in the facility in order for her to receive any coverage. She kept having to go to the hospital because she was not well at all. So every time that she had to leave that facility and go to a hospital, be admitted to a hospital, that window restarted again. And unfortunately, she was never able to satisfy it and utilize her long-term care policy that she had been paying for. So Kit, on that topic, is there anything that you feel like we should cover or that maybe we should discuss in a bit more depth before we jump off here in a little bit? We have a couple questions left, but anything that that you can think of that we should cover with regards to elimination periods, and perhaps what those who have these types of policies need to check with regards to their policies and be sure that they understand.
Yeah, so every carrier has some type of elimination clause, right? Most of them are around in the 3-month window. I think that's because, and I don't have this confirmed by anybody, but typically, like I mentioned with Medicare, you go into a hospital scenario, you have 100 days of benefit, right? That skilled nursing benefit. Well, it turns out most carriers have a 90-day elimination period so that the moment that one benefit stops, another benefit starts, right? There are carriers that have a 0-day elimination period so that the moment that you're certified to be on claim, you're on claim, right? And so if that's of concern, we could look at that. But also one of the things that I would say is it's important for you to know what the elimination period is because you do have to wait. But also this is kind of a feather in the cap to those who want to go the insurance route to look at a life insurance policy with the long-term care benefit or the linked benefit policy. Because let's say in that scenario, we never satisfy the elimination period, right? We're always going and requalifying and things like that. And so we never get the value. In a situation like that, if you just pass away, then the death benefit goes to your family. So the value is still there, right? So that you at least get something for the money that you've spent. That's not a feature with traditional long-term care. It's certainly not something to look at with self-funding. where there's really no kind of death benefit or leverage of which to speak. But if in any solution that we look at, we need to look at elimination period. We need to see if that's something that you're comfortable with the time that is. If that's important to you to try to be on claim as quickly as possible, we have solutions for that. Does that kind of answer that for you?
I believe it does. Thank you very much. And I know I said there were a couple questions left. I believe actually these could be combined into one topic, but just pertaining to qualifying for something like this, if you could please just speak to underwriting, what that is and what those options look like or how that works for the options that we're talking about today. I think that would probably cover, unless anyone else has another last minute question here before we close. I think that would probably cover the remainder of the questions that we have here right now.
Yeah, so the underwriting thing is always something that people were like, well, should I talk about it? Of course we should talk about it. Here's the thing. A lot of advisors have approached life insurance and solutions with life insurance really, really incorrectly. They treat underwriting like a boogeyman. Here's what people need to know. If you were 65 years old, no one, not even insurance companies, have a reasonable expectation that you would be as healthy as a 20-year-old, right? What they're looking at is, what is your health relative to other 65-year-olds out there, right? So if you have high blood pressure, if you have cholesterol, if you even had a stent put in your heart, if you have, bad knees or bad back or whatever that might be, these are very, very, very common things. You had your gallbladder removed or whatever that might be, right? So the thing is that when it comes to underwriting, I got some carriers that will do the full blood draw and urine and everything like that. I have some carriers that only do a phone interview, right? The important thing to know is that life insurance will give you the best bang for your buck as far as the leverage goes. That is if we qualify. If we don't qualify, that's okay. There are still solutions out there that still give you good leverage that are not on the life insurance side, but they are things that can help you out. So when you sit down with the folks over at Reed, let's talk about your health. Let's talk about the medications that you're taking. Let's talk about surgeries and things like that. And my job is, aside from doing all of this, I literally talk to underwriters all day long. I just called somebody, I mentioned gallbladder a second ago. It's because I called an underwriter earlier today to ask, how they rate gallbladder removals, right? That's what I do behind the scenes. So if I know what your health looks like before we submit an application or even look at an illustration, I can identify a carrier in advance that is a great fit for you, both medically and both from a solution standpoint. That's my job. That's what I do every day. So don't think of underwriting as this boogeyman of, will they catch that? They'll always catch it. Just tell us first. Let me sell it on the front end, and we can end up with a lot better scenario than if we just go, surprise, I'm got a pacemaker, right? I mean, it's not one of those things we want to find out after the fact. So let us know, and then let me go to work for you. That's what I do.
And Kit, I think that's a really good point. And one of the benefits of being independent advisors is that we can basically do all the due diligence for our clients. So that's something that we're there for. We team up with you and your team as well, and get to know the client obviously very, very well first. And then we can go and find the right solution for them based on their goals, their goals, their family history, their medical history, all of that. So we take the pressure and the stress off, which I think is really important for people, because it's not necessarily a fun process to go through. So as much help as we can give, we go ahead and do that. And I did want to mention that we have set up a strategy for our father, April and my father, who has joined us today. So hi, Dad, using one of these strategies. So he had and I've gotten his permission to talk about this. He had a term policy because he wanted to make sure that business continuation happened if anything happened to him, unexpectedly, and leave that legacy. And so there were some goals there. And now, as things have evolved, he's gotten a little bit older. He wanted to make sure that he was protected, that he had that long-term care protection. So we were able to help him find a solution that was life insurance with a long-term care component to it. And he is 66, just turned 66, and he he went through underwriting just fine. So we were able to help with that, you and your team. So the solutions are going to be different for everybody, but there is a plan out there for everybody. It might not look the exact same as your neighbors or, your friends, but as long as there's a plan, that's what we're really, really focused on.
Exactly. And, here's the thing I do want to bring up to everybody on the call. If there are a lot of parallels between life insurance and home ownership and buying a home. Okay. And what I mean by that is that if you have a current home and you want to buy a new one, when you sell your current home, you use that equity to put towards a new home, right? So if you have a life insurance policy in force and, there might be equity built up in that, and it's worth taking a look at to see if you have the old insurance that has these types of riders or the new insurance or the old insurance that doesn't or the new insurance that does. If you have the new insurance, that's great. If you have one of the older policies, an old whole life policy or something like that doesn't offer these benefits, can we use that equity to put towards something newer that may better fit your scenario, kind of like what you did for your dad? Also, one of the things that, again, just to reemphasize how you need to approach this conversation in your head, I know that there's plenty of people on this call that have seen HGTV. I'm sure it's on downstairs right now in my house. But when you look at HGTV and you look at house hunters, people always say, what do you want? Well, I want a 2-car garage. I want an open floor plan, obviously, is number one. If this were Family Feud, we always know that that's a open concept's number one answer, right? So, but you want these things. Nobody ever says, I need a place to live, right? So, because that's assumed. So when you look at a life insurance policy, don't worry as much about the death benefit. We know what that is. Think about the features that you want, the things that you want it to cover, the ways in which you want it to be a solution for your own situation. We'll take that into account. We'll find the perfect fit for you. I hope that makes sense to everybody.
Yeah, absolutely. Thank you very much. One thing I like about these solutions too, and then we'll go ahead and wrap up unless there's any other questions that just came up, is that the traditional long-term care is kind of a use it and lose it, which we experienced with our grandmother. She didn't get her money's worth out of that. And that these solutions are different in that you take care of yourself and the needs that you have with a long-term care event. And then anything that you don't need to utilize for that, it passes on to your family as a legacy, which I really think that's an important and really helpful aspect to the hybrid alternative solutions as well.
Agreed. And I do believe that we've answered all of the questions that we had at this point. I did, if I didn't read yours specifically, there were a couple that were pretty similar, so I tried to kind of put those together and make sure that we got to everybody. So if there's anything that you feel like we did not address in as much depth as you would like to hear, or if you had follow-up questions, once you get to speaking about this with your spouse, your family, certainly let us know. We are going to be sending out that checklist, if you will, where you can look at that and help guide some of those conversations. And then we are happy to help you in any way that we can. A big part of what's very important about being a fiduciary advisor and that we take very seriously is holistic planning and making sure that we've really done everything and used all of the resources that we have to help you make sure that you're well cared for and that I know a lot of you, the phrase was mentioned earlier, Kit, I know you said you don't like it, but I hear it all the time that I have people say to me that they don't want to be a burden to their family. So whatever that might look like for you, we're more than happy to help in any way that we can. We hope that you're doing well and in these crazy times that we're in. We're certainly really looking forward to seeing you in person, hopefully sooner rather than later. And whether it's long-term care related or not, we're here to help you in any way that we can. We appreciate you. We miss you. And we look forward to seeing you soon. Thanks so much for joining us today. Thank you, Kit, very much.
Oh, thank y'all for having me.
Absolutely. Thank you so much. You're a great teacher and the information is wonderful. Thank you to everybody that joined us. We love having you here and can't wait to see you in person. We were actually going to do this event in person since Kit is local. So we kind of had to switch the strategy up a little bit, but this has been awesome. I've come to love your blank wall behind you. So don't change it. All right, guys. Thank you so much. It's been a pleasure, and we'll be sending those handouts to you and talk to y'all soon. All right.
Have a good day, everybody.